Welcome everybody, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today we're going to go over the Falcon Flyover, and we're going to talk about the first 9 months out of the year and go over the things that have happened and the impacts that it has on your portfolio. Because so much has happened from what happened in April. People have already forgot about the volatility that we've had since then. So I'm going to spend some time and we're going to go over the Falcon Flyover here leading into Q4. Now we're going to go into our market outlook. And just taking a look to see what has happened in the market since April has been astronomical, as we'll see in the next slide. And the US economy is continuing to be resilient. I mean, just take a look at what's going on. You have wars, and the US economy has maintained to be resilient. It has continued to go up since the drops in April. And we've had now interest rate cuts, we're still fighting off inflation, and the markets are still resilient. Now, when you take a look here into the next slide, you will see, in fact, what has happened here in the orange, where the markets were getting punched in the face. When you take a look at bonds, stocks, international tech, they were getting smashed. Now, since then, when you actually look, since April 9th onward to the end of Q3, you're now seeing the returns of bonds, US, international stock, and tech that has really boomed. And this is extremely important for our portfolios, especially as we have our tilts, yes, into growth companies, which is always important, and US large cap, which is even more important because, as you'll see in these later slides, they have tilts towards profitability, which is always for us what we look to focus on when we're building your portfolios. Because we don't want to get into a phase, we don't want to get into a craze, and we don't want to get into some type of fad that's unnecessarily taking a large portion of your portfolio, which can lead into some type of bubble. And that's the big thing, folks. As we go into the next slide, look at the strong earnings that are coming out. At the end of the day, businesses and companies are still making money. And that is crucial in the understanding of portfolio construction and to see what's going on into the economy today, if that's something that is sustainable. And what we're looking at here, when you look at Q1, when you look at Q2, and you look at the expected earnings versus the realization of earnings, we're actually not doing too bad. As we continue throughout the Falcon Flyover, you're going to take a look at the GDP growth. It is still there. It is still strong. The only thing that seems like it's tapering off a little bit is the amount of new jobs that are coming through. As you can see on the right side of this chart, on those yellow bars, that in fact, that new jobs are slowing down. When you compound that with the AI effect and the productivity of companies now, it's not that it's replacing jobs, it's making everybody that much more productive. And a lot of these tech companies are some of the first companies that are taking full advantage of that. And yes, AI is real. As we go into our slides here, you can see the impact it's having on productivity, focusing on productivity from office and administration jobs all the way down to healthcare. You could see it matters, folks. The impact is real. We're seeing that as simple as maybe having AI help summarize long emails, helping us actually search the web a little cleaner, easier, getting the answers that you need. Heck, even reviewing those long PDF documents, even contracts. Not saying you can 100% rely on them, but boy, oh boy, it's an enhancement and a help to just make you that much more productive. And as I mentioned earlier, as we look at inflation here, you can see that yes, it has slowed down significantly, but it's kind of going up a little bit in certain sectors, as you can see here. You have the major core items from service goods and then energy. And you could take a look that there are certain things that are actually lowering, but certain things that are in fact maintaining flat. And you can see that with services as a whole. So these are the items that you just have to look at as you're looking at overall economic impact and what the future, what the leading indicators are telling you of what's happening right now. Right now, what are we seeing? We are seeing through tariffs, immigration policy, that prices could continue to go up. Now here we are, our Fed chair, Jerome Powell, saying he is going to reduce rates. He's already lowered rates right now. But when you take a look at the Fed cutting rates and you compound that with currently having a good market ahead of us, not expecting a recession. You could take a look what happens historically with the US stock. Since 1990, it goes up by 17% on average with US bonds at 7.2%, versus when the Feds are on pause and Fed's raising rates. So this is actually a positive outlook. Some would say that's why maybe you don't need to lower interest rates. But for you and I, why would we not mind? Well, it's easier for us to buy homes, refinance if you recently bought a home, and take advantage of lower interest rate environments. It makes things more affordable for us, and as multiple consumers, not just us, this helps enhance and grow the economy even more. So what does this mean for you? Well, what this means is, well, if you are in fact seeing rates falling, you could take advantage of that. And with low rates helps enhance growth in our economy. And all this leads to what? Well, staying invested is crucial, is important. And if interest rates are coming up, bonds go up, which is why diversification is still key. And yes, even though the United States dollar has weakened, which, oh, by the way, which helped contribute to increased gold prices as well, by that combination, this is why also internationals had one of its better years that it's had in a really, really long time. So as we look into this, what does that mean? Well, what that means is we're sitting on a bunch of cash, yet again, a historical high amount of over $7.3 trillion sitting in cash. But you have to be careful of that because there are still some savings account paying in the high 3s and maybe even low 4% range. But let's not get so excited about a 4% rate because when US bonds are paying almost 50% more than that, at 6%, the stock market at 15%, and a normal portfolio 60-40 at over 11%, this is where you have to self-assess your situation. What is that cash used for? Don't try to change or time the fundamentals of markets. This is where if you have cash, it should be looked at to be used in the next 1 to maybe 2+ years. But if it's something where it's truly for retirement and you're waiting for a buying opportunity, well, boy, oh boy, the market just went up double digits this year. This is where you shouldn't try to time the market. It's hard to be accurate. As smart as you are, it's impossible to do. So if you have money, you want to put it to work, this is the time to do it, especially as we're entering this age of productivity and economic growth. Because the reality is, we don't see it slowing down anytime soon. What we do see is maybe some impacts with AI, maybe certain AI bubbles that are maybe overvalued in certain aspects. But the reality of it is the technology is here, and the importance of that is for you to be able to participate in markets. Because if you just take a look here, and you take a look at what happens with cash, you look at the eroding of cash over a 1-year period, you could see here on the left, it matters. Versus if you just invested your money. And if you push that and pull that over a 30-year period, that 10,000 gets cut in half. Versus if you just put it to work. Yet again, the money is designed for long term. Who cares about the volatility in the market? You could slowly put that money in. There are other fixed income, alternative, structured note, different opportunities that are out there for you that you could be taking advantage of. The question is no, try to time it. By trying to time the market, it could be a very costly mistake. And what used to be ugly, bad, annoying, bonds. Who wants to invest in bonds? Well, now is the time, as we're going into a low interest rate environment, a rate cutting environment, it could make sense to participate in bonds. As you can see what happens, and when you look at the outlook, when interest rates are going down, well, first off, the correlation is less to the stock market, which is what you want, which historically speaking, stock market goes up, bond prices go down. And when you look at when intermediate term bonds, high yield bonds, emerging markets, private credit, and you look at what the rates are looking like, it's not that bad. I would argue it's really good. And so before you start getting super excited about private credit or high yield bonds, you just have to understand that these have limitations. Some of them aren't fully liquid as well. So you have to know what you want, how long you want to invest, and the taxation of this, of the type of accounts that you have. And yes, when you compare it to what's happening in the bond market in a low interest rate environment, or if the Fed's cutting, take a look. It matters. Look at the returns since 1992 today. It impacts portfolios drastically. It's not just what they're paying you. It's just not the coupon that you're getting, the interest rate you're getting, but the appreciation of the bond matters. So keep that in mind, especially when it's following a pause. You look at bonds, the outperformance of cash, it's a real impact. But I know what you're thinking. And what you're thinking is what? There's always a reason to freak out. And I get it. You still have a hypersensitive political climate. and you always have a reason to sell. As you look into this chart, since what's happened since the great financial crisis of 2008, it's even a bigger chart when you look at it from pre the Great Depression. The point is the markets are resilient. And when you take a look on the right of every single storyline that's out there and what has happened since then, markets are resilient. Companies are resilient. People are resilient. So focus on the things you can control. And that is by understanding markets. They don't care about politics. They don't care about what's going on overseas. They don't care about war. They care about investing in markets that are capitalistic and that can make money over the long term. But I know what you're thinking. The markets are high. We're at all-time highs. It doesn't make sense. It can't keep going up. Now, there is some truth to that. But when you take a look, well, the market's always at an all-time high. And you take a look at the amount of all-time highs this year, or at least for the first 3 quarters, we're at 28 all-time highs. Last year was 57 all-time highs. 2 years prior to that was 70 all-time highs. Like, the market is always at an all-time high. So you have to think to yourself, well, are you looking to participate in that? Because if you're late to the party, it's not the end of the party. For example, better late than never. When you look at after record highs, the 12.5%, and when you look at after non-record dates and non-record highs, for the last 40 years, it still performs similar. And when you look over a 3-year period, sure enough, it's the same logic. You're still getting north of 10% returns. And this is sometimes what people fail to understand. Why is the markets going up? Because we're always in an all-time high. When you look at it, it could be 1 out of every 5 days that we're hitting an all-time high. Now, here we are, the AI bubble. I've been talking about it, right? Well, when you look at the tech bubble, this is an important part, and you look at the earnings growth, which people always talk about that. It's very similar to the dot-com bubble. During the AI bubble right now, we're at 73% growth versus the tech bubble's 80%. But here's where people overlook, and that is the stock return. The stock return to the dot-com bubble was over 400% returns versus right now about 94% returns. And here's another thing. The actual income, when you take a look at these companies and you're looking at the actual revenue and profits that some of these companies are bringing in, they are legitimate. These are companies that are profitable. So comparing it to the tech.com bubble seems fair. I can see it clearly. And there sure are some AI companies out there that will not be around tomorrow. But when you look at still the Magnificent Seven and some of these biggest stocks, as you see here on the next slide, it matters. And why does it matter? Well, take a look. When you take a look at the S&P 500 returns of 14%, and you look at just the tech stock alone at 22%, look at 2023 versus 2024 in year-to-date numbers. These are companies that are growing. Yes, they all have exposure to some type of AI, but all of these companies listed, from NVIDIA down to Tesla, are profitable. They're making money. They're making billions and billions of dollars. And this is the important part where you have to take a look at your portfolio. As for us, you have that exposure. You're seeing it in the numbers. Heck, yes, I understand international has done very well this year and it's overtaking some of your top performers, but big tech and that exposure that we really pushed you guys in 2022 seem to be working out really, really well. Now, you've been hearing a big popular push with options. And I just like to highlight, yes, derivative income is something that people have been using and been asking us about. And yes, that is something that we do for some clients. Just know there's a few things there. Number one, well, the taxation on option income is taxed at the highest of rates. In addition to that, well, it's not a no-brainer strategy. There is a limitation on how much you can make on your portfolio, because if it gets called away, then you actually don't get the growth. So, but for certain people, yes, you're right. Options and option income and covered call strategies have been making a lot of sense, and you can actually see that right here in the chart. It actually compares to bonds, and these are overlay strategies that can happen on top of that. And you take a look at the yield that you can get from covered calls and actually doing it on your portfolio. It does in fact matter, especially when you're comparing it to the dividend stocks and of course a combination of having dividend stocks and then of course doing an option overlay on top of that. So I'm not here to say do it, but I'm here to let you know, yes, it is an option, but it's not something that you have to do. I would say it could be more volatile and you miss out on the upside, and it should be really done for larger and more sophisticated situations. And then lastly, for some of you that are sitting on legacy mutual funds, old accounts, and you have these type of funds, you have to be careful, especially if they're growth funds, because you take a look at the turnover, the average turnover of these funds, which is about 28%, which means if it has 100 stocks to start the year, they're going to sell 28 of those 100 stocks by the end of the year. Well, the thing is, of the amount of embedded gains into those funds, this could be serious situations, because if you're in fact holding onto these funds after everybody else has sold them, guess what the fund manager has to do? They have to sell the stock, and those who are still in the fund are the ones that are burdening on the capital gain distribution, on the capital gain taxation. So please be very mindful. Sometimes it may make sense just to bite the bullet on those legacy mutual funds that you may have outside. And if you need help with that, let us know, because there are ways to mitigate and reduce the taxation of those capital gains. And here we go, the classic chart of diversification. I share this because of what's happened with gold. You ask me, this could be the worst time to buy gold, especially after these major increases. And oh, by the way, the US dollar has already gotten punched in the face. As we're strengthening our international ties, as we're having the settlements of a lot of these tariffs, you can expect the natural growth of the US dollar and the strength of it. And with that, that impacts gold prices as we all live here in America and buy it with US dollars. But you take a look from 2014 to 2020 and every year outside of there, whether it's cryptocurrency to this US stock market to gold or whatever the case is, it's still all over the place. So you want to make sure to understand diversification is key. And I know a lot of people have been asking about cryptocurrency. And sure, for well over the past couple of years, we have had that exposure, and we have said, if you are interested in that. And so we would offer that. For us, it's something that can be part of a globally diversified portfolio. A 1 or 2% exposure could make sense, but that's something we're still asking, if that's something you're interested in, to let your advisor know, because it's still the wild, wild west with cryptocurrency. But what we have been doing for the past few years is the alternative funds. We have been putting people more interval funds. As we see that the markets are volatile, and some people just want exposure to get that 5, 6, 7, 8+% returns without much volatility or interest rate risk. So you have seen that, and you've actually seen the returns here on alternative funds, and you actually see the better diversification piece to it, as it's not as correlated as much as it is to bonds, and it just seems to be much more diversified. So this is something that is being incorporated in your portfolios, and we're really looking to do that for a lot of our portfolios over $1 million, because sometimes these funds do have limitations of having to be an accredited investor. And if that's something where you want to have exposure to that, talk to your advisor about it, because there also might not even be asset levels, but there could be income levels where you could qualify for some of these funds. Because if you control the volatility of the market, you see the ups and downs that are going on right now. If you're able to control that, that could be huge. Because here, even if you, instead of getting 100% upside, 100% downside, and you do it for 90% upside and downside, you actually end up with more returns during this period. And that is important, because sometimes, and I always like to say, the best way to make money is just don't lose it. So as we look to close out, bringing this all together here, number one, holding on to cash could be dangerous. You think it's safe, but you're losing money safely due to inflation and the loss of opportunity of what's going on into the markets. You compound that with what's going on with AI, we are going to continue to hold precious that growth aspect in your portfolio, because we're seeing what the productivity of AI is doing to some of these large firms that are out there, and they are still profitable. And the idea is, because of AI, they're even going to be more profitable. And the last part is diversification. We're still going to maintain global diversification, international, which has done great, US, which has done great, and other alternative forms, whether it is in fact cryptocurrency, whether it is metals, or it is in fact these alternatives that are paying really nice dividends. I discussed this today because of just a simple concept of globally diversified portfolios, and because of our niche and focus of having a profitable portfolio. A lot of you have been noticing and peeling back under the onion and seeing what in fact and what we're investing you in. And we do have some tilts into the portfolio of still profitability, as some would call it value, but it's value in a different aspect. This is value with a focus on companies that are profitable. This is important because some of you have been seeing some Avantis holdings in your portfolio. We have that for large cap, USA, and small cap. We are now going to incorporate that also for mid cap. As you can see, which we're going to attach here, the outperformance is astronomical. And as much as we love Vanguard and have Vanguard and use Vanguard and will continue to use Vanguard versus buying just the index, by actually having tilts of profitability, you could see here the outperformance it's a substantial outperformance of focusing, still having small cap, mid caps, and naturally large caps. And you could see the performance is staggering. And we've made these changes as early as 2021. Not only did it make more, it lost less during periods of 2022, and you've had periods of 3+ years where it had annualized outperformance returns of over 8% a year. Some people are happy with 8% alone. This is an outperformance of 8%. So yes, we love Vanguard. They're great partners of ours. But when you start to look at inefficient indexes, such as small caps and mid caps, this requires a little bit more focus. And for us, focusing on profitability makes a lot of sense. So you're going to start to see a little bit more change in your portfolio to make sure you get the juice that you need to maintain volatility, to reduce risk, and to get that growth. That's literally having your cake and eat it too. Folks, we want to thank you for listening to this. We know it was a longer one, but there was so much going on. If you have any questions, please reach out to your advisor. We thank you so much for your trust. And if you need anything, don't hesitate to reach out. Thank you and take care.